Hello and welcome to the weekly commodity market update. I'm Brownfield anchor Will Robinson, joined as always by the University of Missouri's Ben Brown. Hey, Ben.
Good morning, Will. How are you?
I'm doing well. Hopefully, you also had a solid 4th of July weekend. A lot of fireworks going off. Hopefully, no fires.
I love the 4th of July. It's one of my favorite holidays. Just a great opportunity to be together with friends and family and celebrate America and get to eat a lot of good food. I'm a big hamburger guy, so I don't know what you could complain about. It was a great holiday.
Yeah, where do you watch fireworks at?
So my neighborhood, the neighbors that live around me always have a big block party, if you will. We have lots of kids. Everybody's got kids in the neighborhood I live with, and so they put on a fireworks show for all of them. We probably spent $200 worth of water on the water slide alone, or the slip and slide, if you will. And then I went down to Jeff City and watched the fireworks in front of the Capitol, which was a lot of fun. They put on a great show down there, and it's just cool to sit on the lawn of the Capitol building and watch the fireworks over the river. So.
All right. Well, we did have a day off from the markets being open yesterday because of the holiday. So really catch us up. Where do we sit right now as compared to where we were this time a week ago?
Yeah, a lot different actually. I'm gonna prelude here and just say that we've seen big changes in the last couple of weeks, but especially over the last week too. Maybe of note here. So we are switching contract months now that we're in the month of July. I've switched all of our nearby contracts to a different month than July. For old crop corn, that's a September contract. We were down 66 cents on the week to $5.95. New crop corn for December down 71 cents to 5.82. Old crop soybeans now August, the contract month of the nearby contract month, down 68 cents to 14.61. New crop soybeans in November down 91 cents to 13.41. Looking at those different soybean components, soybean oil dropped another 7 cents per pound down to 60 cents per pound. That's a drop of 20 cents over the last couple of weeks in really that vegetable oil complex. Soybean meal down just slightly, but basically flat on the week at $415 per short ton. And then probably the big story, old crop or the wheat contract, not old crop or new crop, but that September wheat contract down 98 cents on the week to $8.19. The wheat contract has fallen 33% in basically a 2-week period. So big changes there across the board.
So really, what's the driver right now with all that downward action? What highlights are you seeing in the market?
Yeah, let's do highlights of kind of what happened last week and then come back to that question because I think those are two separate things. In terms of highlights, we did receive finally updates on U.S. ethanol and petroleum production and supply and stocks. EIA's servers were down the week before, so we got 2 weeks at the same time. U.S. ethanol production was relatively stable over that 2-week period, somewhere around a million point 0.05 million barrels per day. Corn used for ethanol is still trending about 8% this year over the same period last year, but that surplus has been shrinking. Last week's grain stocks report for June 1 showed corn stocks at 4.34 billion bushels, soybean stocks at 971 million bushels, and wheat stocks at 660 million bushels. All three of those were within 7 million bushels of pre-report expectations. I haven't been doing this for a long, Will, but I have to say I think that was about the most neutral of grain stocks reports I've ever seen. Corn and soybean stocks are all higher than they were a year ago, but supplies of wheat are down about 185 million bushels less than the same time last year. The big story, though, last week was June acreage. Acreage in June is always a big market mover because typically there's a surprise somewhere, and we certainly got that. Corn came in at 89.9 million acres, up 431,000 acres from the March intentions report. Soybean acreage, though, the big story of the day, down 2.6 million from the March intention. That moves about 134 million bushels out of the new crop soybean supply picture. Keep in mind that the USDA is projecting a current 2022-23 carryout somewhere around 280 million bushels. So some higher price or some demand destruction maybe potentially there as well. Export sales were all down week over week. Export inspections were also down week over week. Probably most notable was the lack of China in those export inspections. Only 2.7 million bushels of corn exported to China, which was a big drop off, and then just a smidge for soybeans and grain sorghum, and no wheat was exported to China on the week. That was a lot. I'm sorry, Will.
No. It's like you said, there's a lot of information that we've been waiting on, looking at the energy side of things, but also we're digesting still those acreage and ending stocks reports because the markets haven't really responded how one might think. Just looking at what came out and now how the market's been reacting, maybe not just solely on that, but it's been trading fairly well downward. So really, can you talk about what pressures might be pushing the market down right now?
Yeah, well, let's just talk about the big elephant here. So the big elephant is to take 2.6 million acres of soybeans out of the new crop demand picture, and see soybeans between Friday and really what we've seen to start the week here on Tuesday, to see them down over almost $1.20 a bushel, just in those 2 day periods, right? So like, to see what would be mostly considered a relatively bullish surprise and then see the markets react such strongly down, is I think puzzling to many people. The big story I think that's hampering all of our markets, not just commodities, but spilling over into the broader macro, is global concern around an economic recession, right? So we've seen a major sell-off across the board over the last week, which continues early this week, as traders return from that three day holiday. High inflation numbers in Europe today caused the central bank to react, maybe with some higher interest rates. That sent the euro crashing. It spiked the US dollar to the highest rate we've seen in 19 years. So with the high value and the US dollar, also the Chicago's VIX index, or their fear index, that tells us kind of what the traders are anticipating for some macroeconomic hurdles. With it being elevated and a strong US dollar, that's going to create some major headwinds for commodities over the next couple of weeks. So certainly, I think some macroeconomic sentiment that's saying, hey, we're concerned about meat demand, potentially with higher prices and maybe some less economic activity. Also, some trouble on the export front, just causing the fact the U.S. dollars as high as it is makes our product more expensive on the world market.
Well, it's especially interesting too because just real quick, looking at those acreage estimates one more time, we've been talking about weather the last couple of weeks and how that's going to matter more now that June acreage report has come and gone. So with forecasts still remaining dry, and that's impacting corn more than soybeans at this point. How much more do you see these prices having the potential to drop until that drier weather maybe starts taking control of the market and pushing it back upward?
Yeah, so I think what you're seeing right now is a little bit of fear entering into these markets. I didn't know what to expect to start this week. Last week, the big sell-off right before the 3 day holiday was probably driven by traders just not wanting to be in the wrong position ahead of the long weekend, right? So like, there was, obviously this is all speculation, but there was at least some understanding of what was happening. I may be a little bit surprised to see soybeans down another 70 cents to start the morning today, coming off that 3 day holiday. Those are things that cause maybe some concern that we're seeing some major technical damage in these charts and in these markets. When you look at the fundamental side here, yes, our row crops, corn and soybeans, actually have a pretty solid story to tell, right? Corn added acres, yes, but it was not, a huge increase. And on top of that, there's still about 20 million acres left to be planted at the time of the USDA survey. Does all that get planted? Does it not? We don't know. I would imagine that some of it does not. So these numbers could come down just a little bit by the time we get around to the August production report. But all said and done, the reports last week, especially on the acreage, were very, very supportive, very bullish. And when you look at the demand picture with normal demand, nothing crazy, right? Nothing like another shortfall in South America, or let's say China coming in and buying a whole bunch of corn. Without any major demand driver, the picture looks tight for our row crops. And certainly suggests maybe some higher picture. But I think the sentiment right now is all around macroeconomic factors and the fear of an economic recession, not wanting to get caught. Less driving, so less ethanol use, less meat demand, so less feed demand. I think all those things are coming into the picture. So until the weather changes drastically and gets people talking about weather in a bullish sense, right now the market seems to be heading at least softer for the time being, whether there's a fundamental reason for it or not.
Gotcha. Well, I also want to return to one of the things you talked about, the US dollar value being elevated to one of its highest levels in recent memory. How does that, for the near term, impact exports and what we might see coming out of the US?
Yeah, no. So the U.S. dollar coming in just over 106, which again, this is the U.S. dollar compared to a basket of other commodities. I'll use the example within the last 18 months when we've seen some of these record sales out of China. A couple other countries, Japan, for instance, Mexico's bought in quite a bit of corn, but Japan, Korea, China, let's just focus on those Eastern Asian countries. When they bought a lot of corn, it was when our dollar index was down at like 94, 95. That means that our currency was relatively weak compared to others. Our goods were cheaper if you're an exporter, and we were able to make some pretty large sales. The fact that our dollar has been trending, or our index has been above 100 for several weeks, couple of months now, it's really kind of put a lid on those export sales. Certainly, you look at this week or this most recent week of export sales data, soybeans came in actually negative, signaling that we had more export sales cancellations than we did new sales on the week. And corn, a really small week for corn, smallest of the marketing year so far. So it really does start to play into the picture. We had wondered when the U.S. dollar would start to tailor exports. It didn't happen for a while, as I think people had money to spend and countries were willing to buy sales, but it does seem to, in the last couple of weeks, seem to be becoming a factor.
Well, just how often does that happen on the soybeans, with that becoming a net negative with more cancellation than sales? Is that really rare, or is that common?
So it's not totally unheard of. It happens actually quite a bit when you get to the end of the marketing year, which we've got 2 months this marketing year left. But when you get towards the end of the marketing year, you can see sales cancellations as people cancel sales for their current marketing year, or they roll sales from the current marketing year to the new marketing year, and so it can create some negative values. So it's not unheard of. It's just certainly something that you don't want to see, and it certainly makes U.S. producers unhappy from the standpoint that they can't tell their elevator if they've got a contract into their elevator. They just can't cancel and say, no, I'm not gonna sell my grain. But it's frustrating that other countries can cancel sales with the United States. And so it is frustrating, and it's something that if you're a producer of these commodities, you never want to see that.
Gotcha. And then shifting gears here a little bit, talking about energy. We've talked about the Energy Information Administration having multiple reports from the last couple of weeks finally coming out. Is there anything notable that you'd like to cover there?
So largely held pat on ethanol production. We continue to run at a very strong pace for ethanol. It's been kind of impressive when we look at fuel consumption as well. Given how high prices have been, that we're still consuming as much fuel now as what we are, and that gives positive outlook for ethanol production, ethanol consumption moving forward as we head towards the end of the marketing year here. I do see signs within this energy data that we are seeing some less travel due to higher prices, but it's not drastic. We're still seeing some fundamental signals that support these higher gas prices from the standpoint that our stocks are low, production is not ramping up, and certainly in the international market, some of the international players have not increased production to the level that they said they would. So that's certainly supporting higher prices across the board, whether it's gasoline for motor vehicles, whether that's distillate fuel for aircrafts and heating oil. They all remain elevated due to low supply.
All right. Well, if producers want to keep an eye on the energy market, there's an ethanol report that comes out on Thursday. We have the monthly May recap for export sales on Friday, and also export sales for the week that comes out on Friday, with everything bumped back for a buy day from the holiday on Monday. If there's more information that listeners would like to find, that can be found at brownfieldagnnews.com. Also, check out our counterparts, Megan Grebner and Scott Brown, with a weekly livestock market update on brownfieldagnnews.com. Thanks, Ben, for joining me. I'm Will Robinson on Brownfield.